Hello traders, welcome back. Today is the 30th of September. My name is Neville Hornsey, market analyst for YouTrading, and today I'll be taking a look at the British pound versus the US dollar. First thing I want to do is take a look at the YouTrading.com Forex heat map, and I can see that the US dollar is basically being weaker today for the London session, and the British pound has been stronger. The strongest currency relative to all the others is the Australian dollar, and the weakest looks like it's going to be the euro. So if we just go to a calendar, here we have in the morning, we had UK GDP quarter on quarter, year on year, and they both came in better than expected. And now we're just getting the US economic data. So US core PCE, which is what the Fed FOMC look at as their inflation metric. 6.1% came in as expected. And then GDP, the final. So when it says final, that's basically everything's been baked in and without a real big surprise, not market moving. Initial jobless claims, it's in green, but that means it's 362 above what was expected and above the previous. So we're seeing US fiscal flows dying off at the moment. Obviously, about 40% of those flows go into like corporates, which then obviously filters down to people like us, people who need jobs. And yeah, we can see that the US initial jobless claims are rising the last few weeks. So this is not good for the Fed's mandate of having price stability and maximum employment. We're going to get to the US Chicago PMI in a little while, and then we've got more US Fed speaking. So it's going to be a bit of a choppy day today. So far, the initial data out of the US was good, but this US jobless claims is going to weaken the US dollar, I'd imagine. And then we're looking for this good GDP data to sort of keep the pound strengthening. So obviously that would be the idea. But if the US Senate and Congress come back and say that they've passed all the bills, that they've sorted out the US debt ceiling and things like that, then everything could turn on its head 180 degrees. So if we go to the actual active trader platform, this is the British pound versus the dollar on the weekly chart. And if you look at the moving averages, red is 20, green is 50, cyan is 200 periods. So come down to test the weekly 200 period moving average. At the 20, the 50 are still stacked bullishly. So momentum to the upside, obviously bottomed out in March 2020. COVID took out this big support line here from Brexit. So these were the Brexit lows. Retested in 2019, COVID smashed with them, straight back up. Support became resistance. Support didn't offer any resistance, became support again here, and we grinded all the way up. Still think we're going to take out that swing high here, that double top from 2018. Always been on my mind that we're going to go and test that at some point. So maybe this pullback, this sort of corrective move, this maybe ABC move down towards the weekly 200 has now completed that correction of this move from the lows. And yeah, maybe we can get going again up towards 1.43. All right, if we go down to daily, we can see that from 1st of March 2021, so we had a year of rising prices. And now we've had however many months that is, 6 months basically of going sideways. Just taking out this double bottom here. So if you imagine like on the weekly chart, we had the Brexit lows, and we had like this double bottom here, taking that out, but haven't come back up to test it yet. Did come down to test this old resistance. So resistance becomes support, and we're just sort of testing that zone again. If we can get it back above 1.348, then we've got a chance of testing this support, this double bottom support. So if that acts as resistance, then we come back down through this messy, choppy channel. And yesterday I said that below 1.27, everything gets a little bit cleaner. So we had like a swing high for resistance, broke that, came back down, swing low for support. So we just, if we got below 1.27, then things would be a lot clearer for a short. But if we're looking for longs because of good GDP data from the UK and bad jobless data from the US, then this sort of move today could be off this resistance now support line. Going down to the hourly. Obviously, we've been moving down quite swiftly. This was the 27th, then the 29th, and this is the 30th. So the last few days, starting off from last week, really, downturn, momentum's been to the downside. And if I just quickly go to this chart. So when you're talking about Forex, obviously there's no centralized volume. So this is just for the broker that this data feed comes from, but it gives you an idea of where the activity was. And you can see that when there's a big move down, there's very little activity, very little volume. So as an activity monitor, it's saying that when we get a sideways movement, that's when the volume sort of picks up and builds up, should I say. So that obviously is one way of looking at these ranges as being where the volume is, where the most activity was, and obviously where the resistance is going to come in. So going back to here, using that concept of most of the volume, most of the sort of activity was actually in here, not on this move down. If we get above this sort of little box, if I make it yellow actually, so you can see it. So if we can get above this range of 1.352 up to 1.355, get above there, we'll be obviously above the 20 and the 50 period moving average on this hourly chart. And then we could like go and test into this old support, maybe resistance at the 200 period moving average. And if we go back to that previous chart and do the same thing again, where you put the volume across the London and US session, you can see like the point of controls, this is more of a balanced volume day. Obviously it's a whole sideways day. So in the middle of that range is where the most activity was. So going back, so up here, this line here. So if we get above 1.37, the big figure, I'll just put this in here. Then if we go to the 4-hourly chart, would still be underneath the 4-hourly 200 period moving average, and would still be below the 50 and the 200 daily moving average. So even if we get above 1.37, there's still no guarantee that we can get through the middle of this larger range, but obviously we'd be above this support and above this balance area here. So that could be potentially a new level of support. And then we can accelerate and take out these swing highs here. So going back to the hourly, unfortunately, a lot of this does depend on what happens in the next sort of half hour, really, when we get the US Open. So I'm assuming that we've come up, found resistance, came back down to support here. And then we're looking to see if 1.3455 can now, after this sort of big breakup on the hourly chart, if we can get prices to come down, test this old resistance and find support, then we'll be looking to like step up into these sort of areas here. So we have the 50 period moving average to contend with. Then we'll have the lows from this little balance area here. And then you can start seeing how, the balls take the stairs. So you basically go, I'll just get an arrow. You'd come back down, find support here. Then a quick move up to the next level of resistance. Maybe break up a little bit, come back down, test for support now, break up. And then that's, the way we'd play it all the way up, back up to 1.362 and the 200 period moving average. So that's what I'm looking for to the upside. Obviously, if the US session opens up and we come crashing down, I'll be looking for a breakdown, retest, and then a continuation that way. But I really don't want to be messing about here, because obviously this is where, you know, like this box here, this is where most of the volume is, and that's where you can get chopped up. So I want to be outside of this range, and I want to get in as close to the sort of highs as I can if I'm going to go long. And then that gives me a chance to put my stop underneath quite close to that level. And then my target would be at least to, well, like a risk to reward of 1 to 2. Same for the downside. If we look at the oscillators on an hourly chart, oscillator of the stochastic isn't really offering us much in terms of, you know, if we got back above this sort of resistance and came back down on the oscillator, then you could say, oh, maybe it's a good time to buy because it'd be essentially oversold. MACD, there was a low and then a lower low, but you see here that the MACD itself is making a positive divergence. So positively diverging to price. As price came down, made lower lows, the MACD didn't. So that's another bullish sign on the hourly, and the same on the RSI as well. So as price came down, made new lows, the actual RSI in the oversold levels didn't actually confirm that move. So I'm looking for a bit of a bounce. I mean, one spot 345 to one spot 3489, maybe 9. It could be 40 pips if you can get in a decent level. So if you're making 40, you can risk 20, you know, to get that risk to reward. But that's kind of how I'm seeing it. I'm seeing like just intraday, it's the end of the month, it's the end of the week, essentially, when tomorrow, 1st of October, that's the new US fiscal year. There's going to be a lot of wrangling in the politics, you know, trying to get these different debt ceilings, you know, to rise. We're going to get infrastructure bills, all sorts of things going on, which could either strengthen or weaken the US dollar. But just for now, looking for the economic data to sort of guide us for a fundamental reason to get on this bullish move, should the technicals work out and this little bit of resistance now act as support. All right, I'll catch you tomorrow. Take care.